Well, our next guest says the rally we've seen in stocks is based on a hope and a prayer. He says Germany and France have, quote, no plan, and the current optimism in equity markets will soon dissolve into an oh my God moment. Well, joining us now is Mark Grant, Managing Director of Southwest Securities. A year ago, Ireland announced more bank bailouts, and that's when Mark told Bloomberg TV that the optimism then was faulty and Europe's problems would spread. So, Mark, clearly ahead of the curve on this. Why is the market so optimistic at this point? I mean, what has been said that's concrete enough to spur this much optimism?
Nothing. Absolutely, positively nothing. As a matter of fact, France and Germany do not have a plan. They have not put forward a plan. The word is that the two prime ministers aren't in agreement. And I think the equity markets are rallying on that the fairy godmother is going to show up from the European fairy godmother from Grimm's fairy tales or something.
So you've written quite a bit over the last couple days, specifically about Dexia. What is that situation indicative of or symptomatic of? Do you think we're going to see more banks like Dexia, and what's going to be the toll that's ultimately taken on France and Germany as a result for not acting sooner?
Well, just in the last 4 or 5 days, there have been 3 European banks, one in Denmark, one in Greece, with Dexia being the largest, that have gone bankrupt because they couldn't get funding. In the case of Dexia, Belgium bought out the Belgian part of Dexia, the bank in Belgium, for $5.4 billion. But they also went ahead and they're having to guarantee close to $50 billion. France taking 40-some-odd billion dollars in guarantees, and Luxembourg the balance. So if you add the new debt assumed by Belgium in terms of the bank buyout and then in terms of the guarantee, you've now raised Belgium's debt to GDP ratio to 120%, which puts it right where Italy is and not that far behind Greece, which is very problematic, I think, for the country.
And you sent exactly that out, actually, in an email this morning, specifically that you think Belgium is underestimating their exposure as a result of Dexia or potential losses. Why do you think that is? Are they just trying to get a handle on the situation? Do they just not have any ability to accurately assess their real exposure? Or do you think there's some attempt to just calm markets and prevent the crisis from worsening, at least in terms of the market's reaction?
Well, the Prime Minister of Belgium said that their debt to GDP ratio was only up 1%. And to come up with that number, he only included the amount that they paid for the bank and not the guarantees, which are clearly a liability of the country. So in my honest estimation, I think he was trying to mislead the markets and put the best face he could on it, but it's an inaccurate face.
Mark, I want to point to, you also point out that maybe the credit markets have sort of caught on to what's going on, but the equity markets haven't. And we made a little map here that takes a look at a number of, these are just 2-year sovereign spreads throughout the region. You can see over the last, say, 1 month, Belgium spreads have actually come in, as have Spain and Italy, while Germany, France, Greece, of course, is off the charts, and Portugal have all widened. So do you think right now even the credit markets are missing the boat on what's really happening there, given the fact that spreads have actually come in on 2-year sovereign debt within Spain, Italy, and Belgium?
Well, I don't think that the credit markets understood the issues that were going on with Dexia. I mean, Dexia just came out of the blue because they couldn't get funding. I suspect when the credit markets start re-examining this, Moody's, as a matter of fact, put Belgium on a negative watch on Friday, and I think you're going to see Belgium downgraded, and frankly, I think you're very close to seeing France get downgraded because of its economic issues and also because of its further guarantees of Dexia. And once France gets downgraded, then the whole construct is in trouble, and people are going to begin to pay a lot more attention to it.
At what point do you think Europe will become an attractive place for investors to be looking for opportunities?
I don't think we're anywhere close to that. I think Europe is so rife with problems, both sovereign debt problems and bank problems, sovereign debt problems coming up in Italy. I think that both Portugal and Greece are going to try to get more money out of the European Union. And what the real issue is, The bellwether country of Europe, Germany, has an economy that's $3.3 trillion versus the United States as a comparison, which is $14.2 trillion. And Germany and France are trying to support all of Europe, and they just don't have enough capital to do it. So I think that a lot more serious problems are just weeks ahead in the offing.
Mark, connect the dots for us back to the U.S. and U.S. banks. Over the last couple of weeks, we've seen financial shares trading up and trading down, Morgan Stanley in particular, and there was a lot of speculation about its exposure to what's happening in Europe. To what extent do you think the banks here are perhaps have priced in too much optimism?
Well, I think the banks in the United States have done everything they reasonably can to cut back on their exposure to Europe. I have heard from several sources that the Fed has encouraged this, but certainly we saw Friday that the banks in Europe had deposited the largest amount of money at the European Central Bank that they had since June 2010, and that's telling you that the banks in Europe don't want to lend to each other. And we already know that the American money market funds, for certain, have cut back on what they're willing to lend to the European banks. So while there's some exposure in the United States, and there's certainly some speculation with Morgan Stanley, I'm fairly confident that the U.S. banks are in much, much better shape than their European counterparts.
All right, Mark, we got to end it there. It's an up note, which is probably hard given some of the emails I've seen from you lately, but do appreciate you joining us here on Street Smart today. Thanks so much, Mark. Good to see you.
Thank you, Lisa.
That was Mark Grant of Southwest Securities.